Question 10. Are there other ETFs with similar objectives of BOIL ETF, but lower expense ratios? BOIL ETF offers leveraged exposure to natural gas, but it comes with a price, its expense ratio. While there's no exact equivalent with a lower expense ratio, there are alternative ETFs that target similar objectives with potentially lower fees. Here's a breakdown of your options. Alternatives with leverage. Direxin Daily Natural Gas 2x Shares, DUG. This ETF offers 2x daily leveraged exposure to the natural gas market, similar to BOIL. However, it's crucial to compare the expense ratios. While DUG's expense ratio might be slightly lower or higher than BOIL's depending on the specific time, both involve leverage and carry similar risks. Velocity Shares Daily 2x Long Natural Gas ETN, GASL. This exchange-traded note, ETN, functions similarly to DUG, aiming for 2x daily leverage on natural gas. However, unlike ETFs, ETNs are debt obligations of the issuing bank, so they carry additional credit risk compared to ETFs. Alternatives with reduced leverage. United States Natural Gas Fund, UNG. This ETF offers direct, unleveraged exposure to natural gas futures contracts. While it won't magnify gains or losses, like BOIL, it provides a more traditional way to invest in natural gas without the risks associated with leverage. The expense ratio of UNG is likely to be lower than BOIL as it doesn't involve leverage. iShares Global Energy ETF, IXC. This ETF offers broader exposure to the energy sector, including companies involved in natural gas exploration, production, and transportation. While not a direct play on natural gas prices, it can benefit from rising natural gas prices if the companies within the ETF hold significant natural gas assets. The expense ratio of IXC will likely be lower than BOIL due to its broader holdings. Question 11. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, in theory, a combination of individual stocks and/or other ETFs could achieve a similar outcome to BOIL, potentially with lower costs and greater control. However, this approach requires a more active management strategy and carries its own set of risks and considerations. Here's a breakdown of the possibilities. Building a basket of natural gas stocks. Selection. You could research and select individual stocks of companies involved in various segments of the natural gas industry, such as exploration, production, transportation, or storage. Diversification. By choosing companies across different segments, you can achieve some diversification within the natural gas sector, potentially mitigating risk compared to relying solely on the performance of natural gas futures contracts, like BOIL. Active management. This approach requires ongoing research, monitoring company performance, and potentially rebalancing your holdings to maintain your desired exposure. Costs. While some brokerages offer commission-free stock trading, there could still be fees associated with individual stock purchases. Additionally, some natural gas companies might pay dividends, which can add complexity to your strategy. Combining ETFs. Leveraged and unleveraged mix. You could combine a leveraged natural gas ETF, like DUG or GASL, with an unleveraged natural gas ETF, like UNG, to create a custom leverage ratio. This approach offers some control over the level of magnification in your exposure to natural gas prices. Broader energy sector ETF, including an ETF like IXC, which offers exposure to the broader energy sector, can diversify your holdings and potentially reduce volatility compared to focusing solely on natural gas. Lower expense ratios. By strategically combining ETFs, you might achieve a lower overall expense ratio compared to BOIL. Complexity. Managing multiple ETFs adds complexity to your portfolio and requires ongoing monitoring of each holding's performance. Important considerations. Time commitment. This approach requires a significant time commitment for research, portfolio management, and rebalancing. Risk management. While potentially offering some control over leverage, careful management is needed to avoid excessive risk. Expertise. Successfully replicating BOIL's objective with individual stocks or a combination of ETFs requires a strong understanding of the natural gas industry, financial markets, and portfolio construction techniques. Question 12. What are the pros and cons of this BOIL ETF compared to similar options? Here's a breakdown of the pros and cons of BOIL ETF compared to similar options, considering factors like leverage, expense ratios, and diversification. BOIL ETF. Pros. High potential returns. Due to its 2x daily leverage, BOIL offers the potential for amplified gains if natural gas prices rise. Simple investment. BOIL provides a straightforward way to gain exposure to the natural gas market without directly buying futures contracts. Cons. High risk of loss. Leverage also magnifies potential losses if natural gas prices fall. Higher expense ratio. Compared to some unleveraged alternatives, BOIL's expense ratio can eat into returns. Limited diversification. BOIL focuses solely on natural gas, offering no diversification within your portfolio. Similar options. Leveraged alternatives, DUG, GASL. Pros. Similar leverage. These alternatives offer 2x daily leverage, potentially leading to amplified gains like BOIL. Potentially lower expense ratio. Depending on the specific ETF, the expense ratio might be slightly lower than BOIL. Cons. Similar risks. Leverage still magnifies both gains and losses, carrying similar risk to BOIL. ETNs versus ETFs, GASL. If considering GASL, an ETN, be aware of the added credit risk compared to ETFs like BOIL and DUG. Unleveraged alternatives, UNG. Pros. Lower risk. UNG avoids the magnified losses associated with leverage. Lower expense ratio. Typically, UNG has a lower expense ratio than BOIL due to the simpler structure. Some diversification. Indirectly provides exposure to a basket of natural gas futures contracts, offering some diversification within the natural gas market compared to BOIL. Cons. Lower potential returns. UNG won't magnify gains or losses like BOIL, so potential returns might be lower. Broader energy sector ETFs, IXC. Pros. Diversification. Provides exposure to a wider range of companies within the energy sector, not just natural gas. Lower expense ratio. Typically, IXC has a lower expense ratio than BOIL due to its broader holdings. Cons. Indirect exposure. IXC's performance isn't directly tied to natural gas prices, and gains from rising natural gas might be muted compared to BOIL. Question 13. What are the potential benefits and drawbacks of investing in BOIL ETF compared to individual stocks within the same sector? Here's a breakdown of the potential benefits and drawbacks of investing in BOIL ETF compared to individual stocks within the natural gas sector. BOIL ETF. Benefits. Simple investment. BOIL offers a straightforward way to gain exposure to the natural gas market through a single holding. You don't need to research and select individual companies. Leveraged returns. BOIL aims to deliver double the daily return of the natural gas market index, potentially amplifying gains if natural gas prices rise. Liquidity. ETFs generally trade with high liquidity, making it easier to enter and exit positions, compared to some individual stocks. Drawbacks. Limited control. You don't have any control over the specific companies underlying BOIL. The ETF tracks a basket of natural gas futures contracts, and you don't get to pick and choose winners within the sector. Higher expense ratio. BOIL typically has a higher expense ratio compared to some individual stocks you might buy directly. This expense ratio eats into your returns over time. Volatility and risk. BOIL's leverage magnifies not just gains, but also losses. Even small price movements in natural gas can lead to significant swings in BOIL's value. Individual stocks. Benefits. Stock selection. You have the freedom to research and select individual companies within the natural gas sector based on your analysis of their fundamentals and future prospects. This potentially allows you to outperform a broad ETF like BOIL. Potential for higher returns. If you select winning stocks within the natural gas sector, their returns might outpace BOIL's performance, especially if the ETF experiences losses due to its leverage. Potential for dividends. Some natural gas companies might pay dividends, which can provide additional income on your investment. BOIL itself doesn't pay dividends. Drawbacks. Research and analysis. Selecting individual stocks requires significant research effort to understand the company's financial health, competitive landscape, and future growth potential. Diversification. Investing in a single company exposes you to the specific risks of that company. Owning a basket of individual stocks within the sector can help mitigate this risk, but it requires further diversification efforts. Liquidity risk. Some individual natural gas stocks, especially smaller companies, might have lower trading volume and liquidity compared to BOIL. This can make it more difficult to enter and exit positions quickly. Management time. Actively managing a portfolio of individual stocks requires ongoing monitoring, news tracking, and potentially rebalancing to maintain your desired exposure. Question 14. Would adding BOIL ETF improve the portfolio's diversification or potentially increase concentration risk? Adding BOIL ETF to your portfolio is unlikely to improve diversification and might increase concentration risk. Here's a breakdown of why. Limited diversification. BOIL provides exposure to a single commodity class, natural gas. While commodities can offer some diversification benefits compared to traditional stocks and bonds, relying solely on BOIL limits the diversification potential within your portfolio. High correlation with natural gas market. BOIL's performance is heavily tied to the natural gas market. If the natural gas market experiences a downturn, it's likely that BOIL will also experience significant losses. This reduces the diversification benefit because ideally, different asset classes in a portfolio would have varying degrees of correlation, helping to mitigate risk. Concentration risk. By adding BOIL, you're increasing your portfolio's concentration in the natural gas sector. This means your overall portfolio performance becomes more reliant on the price movements of natural gas. Potential benefits in specific scenarios. There might be some niche cases where BOIL could be used strategically in a portfolio. Short-term hedge. For investors with a large exposure to assets negatively impacted by rising natural gas prices, a small allocation to BOIL could be used as a short-term hedge, though this strategy requires a sophisticated understanding of the risks involved. Speculative play. Highly risk-tolerant investors with a strong understanding of the natural gas market might use a small allocation of BOIL for a short-term, speculative play on rising natural gas prices. Alternatives for diversification. Here are some ways to improve your portfolio's diversification instead of using BOIL. Broad market ETFs. Invest in ETFs that track broad market indexes, such as the S&P 500 or total stock market indexes, to gain exposure to a variety of companies across different sectors. Bond ETFs, including bond ETFs in your portfolio, can offer diversification benefits as bonds often have an inverse relationship to stocks. When stocks decline, bonds tend to rise, and vice versa. Commodities ETFs. consider broader commodity ETFs that offer exposure to a basket of commodities, including potentially some exposure to natural gas, but also other sectors like metals and agriculture. Question 15. Does BOIL ETF offer a unique exposure that wouldn't be easily replicated through other holdings? BOIL ETF offers a specific type of exposure that can be difficult to replicate perfectly through other holdings, but there are ways to achieve similar results with potentially lower risk and more control. Here's a breakdown of BOIL's unique features and alternative approaches. BOIL's unique exposure. Leveraged daily returns. BOIL offers 2x daily leverage on the Bloomberg Natural Gas Subindex. This means it aims to magnify the daily gains, or losses, of the natural gas market. This type of leveraged exposure is difficult to replicate through most traditional investment vehicles. Alternative strategies. While not an exact replica, here are some ways to achieve similar goals with potentially lower risk and more control over your portfolio. Combination of ETFs. Leveraged and unleveraged mix. You could combine a leveraged natural gas ETF, like DUG or GASL, with an unleveraged natural gas ETF, like UNG, to create a custom leverage ratio. This approach offers some control over the level of magnification in your exposure to natural gas prices. However, both leveraged ETFs still carry the risk of magnified losses. Broader energy sector ETF. IXC or similar options, including an ETF like IXC, which offers exposure to the broader energy sector, can provide some indirect exposure to natural gas prices if the companies within the ETF hold significant natural gas assets. This offers diversification and avoids the direct leverage risk of BOIL. Individual stocks, high risk. Active selection, building a basket of individual stocks of companies involved in natural gas exploration, production, transportation, or storage allows for selective exposure within the sector. However, this approach requires significant research, ongoing management, and carries the inherent risks of individual stocks. Alright, Chat ETF fam, that's the wrap on BOIL. So, should you jump in? Here's the takeaway. BOIL offers leveraged gains on natural gas, but remember, leverage cuts both ways, magnifying losses too. It's a risky play, not a buy and hold, for most investors. Looking for ways to play natural gas with potentially lower risk? Consider these options. Unleveraged natural gas ETFs, like UNG. Broader energy sector ETFs, like IXC. Building a basket of individual stocks in the natural gas sector. Ultimately, the decision is yours. Do your research, understand your risk tolerance, and choose what fits your investment goals.